Okay, everybody, it's July 3rd. It's Sunday, and I'm here in order that I give you a lecture for this week because we're gonna miss our class time again, which is somewhat my fault. I didn't realize that the holidays well, I should have known better. I mean, these summer holidays, and my ADI, Maureen always says, "Well, when do you want to do it?" And I said, "Well, Monday nights seem to be the right night." And I just wasn't thinking. So anyway, um, scary that I wasn't thinking, but that's the way it goes. We um, we will have our next meeting on July 11th. In the meantime, I'm going to do chapter 9 here and give you a lecture to look at this week. And again, I am open to whatever it is that you need. So if I'm not connecting with you, please keep trying. So we got to get a time where we can get together. If that and it is possible, I promise. So try and get a hold of me, and we'll do that. As you can see, the whole course is open now. Oh no, not these 11. So I'm going to do chapter 9 today. I'll open up the rest of the course here this maybe tomorrow if I get a moment. I know we have some parties to go to. A very important day, a day of secession, is Independence Day. Where we have It's nice we celebrate that together. We all have common shared beliefs and freedom, and that's what this celebration is all about. Um, a lot going on in the markets and elsewhere. I hope you're keeping up with current events a little bit because there's an argument over whether we're in a recession already or whether there's going to be a recession or all sorts of things like that. And that I'm going to comment on these things as we talk about the interest rate, and we're going to get into bonds pretty soon, but not today, I don't think. But nonetheless, you're going to college at a very important moment in time, and I can't stress that enough. I mean, we're in a time where we have an incredible debt hanging over us in the United States. And what's going to happen with that is a big question mark, and the the whether or not we're going to fall into recession here is I think we're already in it, but you may not. But nonetheless, all these things are important, and taking this class and an economics course well taught will give you a real understanding of maybe what's going on in the economic world. So, but nonetheless, I don't want to beat that horse too much on a Sunday, and it's 2:24 in the afternoon on the 3rd. As I said, this is Accounting 121. If you haven't gotten started on this work, you're running out of time to, I think, make it and get through 12 chapters. We're on chapter 9, and this one is on accounting for current liabilities. So without further ado, let's jump right into it. And I may open, oops, I don't want that. I want a slideshow from the beginning. Oh, really? Is that what it's going to do? I don't want it to do that. Why is it doing that? Always use subtitles. Nope. So I'm having a little bit of a problem. Slideshow, use presenter view. No, I don't want to use presenter view. Boom, that's the problem. So back to my slideshow from the beginning. There it is. All right. And I should be able to click right along here. Current and long-term time liabilities and their characteristics, identify and describe known current liabilities, right? As we said, assets equal liabilities plus owner's equity. So uh, these are current liabilities, things that we have to pay reasonably quickly. Times interest earned ratio, and use it to analyze liabilities. And then our entries are going to be short-term notes payable. And we're going to talk about payroll, which you may or may not have run into before, but payroll, everybody's been paid, I'm sure. So it should be interesting for everyone. So how do we describe these current and long-term liabilities? Let me just make sure I'm recording. I am. Defining a liability. It took us, 9 chapters to finally define this. No, we're going over it again. You should understand what a liability is by now. A past transaction or event. Due to a past transaction or event, the company has a present obligation for future payment of assets or services. Okay, so that's what we're talking about, and that's what's important about this. So how do we classify them? Current liabilities due to 1 year or the company's operating cycle if longer. Long-term liabilities due after 1 year or the company's operating cycle if longer. So what would be the exceptions here? Well, like Boeing, I don't know, it takes 2 years to make an airplane. I'm not sure that's true. I use it as an example, but I'm really, I just made that up, but it might take longer than 1 year. But current due within 1 year, the operating cycle. What's the operating cycle of Target? Well, it's about a month. They want to, as long as it takes to turn over their inventory. So look at Dick's. Dick's Sporting Goods, 74%. Our current liabilities. Bowl America, 3.1 million at 69%. Facebook, 47%, right? Current. Is that interesting? I don't know. Sometimes, right? Here we go. A single liability, here's what they say, can be divided between current and non-current sections if a company expects to make payments in both a short and long term. And we'll get into that. I have a current portion of my long-term liability that is a mortgage. It's a 30-year liability, a long-term liability, but the current portion is what's due next month or this month. There's some uncertainty. Accounting for liability involves answering 3 important questions. Whom do I pay? When do I pay? How much do I pay? Answers are often decided when the liability is incurred. So, these are the way these things go. Go back to my slideshow. Oops. And whom do I pay? How much to pay? Known liabilities, AP, right? AP, sales tax, unearned revenues, notes payable. These payroll obligations, right? Multi-period known liabilities, like I just mentioned, a mortgage. Home Depot on August 31st sold materials for $6,000. There's a 5% sales tax, and that's about what, if you go to Lowe's here in town in Glenwood Springs, I think it's 11.9 at the Meadows, which is outrageous. I don't like taxation, period, as you might have guessed. But nonetheless, we are in the state of Colorado. We're sort of what you would call a sales tax state. we get a lot of and a lot of people think that's fair. It's more equitable to use the sales tax because it gets the rich and it gets the poor and it gets everybody. I don't know if you feel that way, but those are questions for our econ class. But nonetheless, you got these sales and sales tax payable. Um, and remember that this doesn't include this. Oops, I'm going to go back. Shoot. That just makes, I know, having a little trouble. There we go. I got to learn how to do this online better from the current slide. So those are the known liabilities. And then we have, they sold this 6,000 times 0.05 or times 5% is 300. But remember, we also debit cost of sales and inventory, right? It's leaving that part of the ledger, the general journal out. So Selena, one of my very favorites. I just think she's the greatest. I don't know much about her music, but I just think she's awfully neat, and I've seen her act a few times. Selena Gomez sells $900,000 in tickets for 3 concerts. Well, she didn't perform the concerts, so it's unearned revenue, right? On October 31st, she performs a concert. So you got to debit unearned revenue and credit ticket revenue. Yes, credit ticket revenue to record concert revenues 900 times a third. Okay. Now prepare entries to account for short-term notes payable. Here we get into the interest rate again. One of my favorite subjects, as you know, a written promise to pay a specified amount on a stated future date within 1 year. Most notes bear interest unless you get them from your parents or someone who loves you and they don't need an interest payment, but most people want an interest payment. And maybe your parents want an interest payment just to help you learn what the time value of money is. This is all has everything to do with the time value of money, and that's an important concept. So these short-term notes payable might arise from overdue accounts payable, right? COVID hits and we're unable to pay some of our short-term obligations, our short-term liabilities. So we have an overdue accounts payable, or we may be borrowing from the bank. And companies borrow from the bank to finance, summertime payroll. If you're a wintertime business, like here in the Valley, it might be Skico might have to borrow in order to supplement its cash flow in the summertime. I don't know if that's true. It may or may not be true. Hopefully it's not. But this is a note given to extend a credit period, date of replacement. On August 23rd, Brady Company asked McGraw to accept a $100 cash 60-day 12% $500 note to replace its existing $600 accounts payable. So they went into Brady or into McGraw and said, "Hey, we're having trouble. As a sign of good faith, we can pay you $100 now. Would you mind writing a note for us?" And when I say write, I say writing a contract. And write a note for us, and we'll pay you in 60 days at 12%. Okay, short period of time. Yeah, you probably got to pay that kind of dough. So this is how the journal entry looks. $600 in accounts payable is credited. Right? We're going to reduce it with a credit, AP. I mean, a debit. Geez, I'm sorry. Debit over here. We're going to reduce our payable, a liability, with a debit. And then we're going to increase or decrease our cash by $100 with a credit, and we're going to make a payable, a note payable. So we're really just swapping liabilities here. Sent cash and a note for payment on account. So we have a note for payment on account. Now on October 22nd, the note is due, right? Now, notes payable, McGraw, we had 500 left on that 600 because we paid him 100. We had an interest expense. How do we calculate the interest expense? Well, it's down here. 500 times 0.12 times 60 divided by 360, or 1/6. Okay. Notice we use 360 for banking, right? Always for banking we use the shorter time, and it's just because it divides. And people say, well, whenever anybody asks me, I make the joke, why is it like that? I would say, because I said so. But there is a reason. It's just better divisibility. You could do it in your head. For all of our ratios, we use 365 days. But for banking, 360. It's been that way for, as far as I know, forever. So it's $10. We paid $510 in cash and $510 in this notes payable at the end of the note, right? So if I had my buttons down here, I could go backwards, but I can't to show you that. Maybe I'll fix that for next one of these I do. Now, to borrow from a bank, on September 30th, a company borrows $2,000, $2,000 from, that's an old phrase, $2,000. You see, hear me throwing that around. I hope I don't confuse you. 20 grand, that's $20,000. That's what I was taught. On September 30th, a company borrows $2,000 from a bank at 12% interest for 60 days. Now, September 30th, right? 30 days has September, April, June, and November. So September, October, November. So 30 days plus interest would be, 60 days plus interest would be November 29th, right? October has 31 days. I could show you how to do, count the days on your fingers and toes. But anyway, the company repays the principal of the note plus the interest. That means we would credit, right, interest expense. The company pays. We also credit the notes payable, repays the principal. So, debit, God darn it. Why do I keep saying that like a dum-dum? This is debit, left, mental block, me. So, two notes payable, we debit a payable, we debit a liability. I'm so sorry. I hope I didn't confuse you. Debit a liability, right, to lower it, and debit an interest expense to increase it. So, and then we credit our cash because we paid the cash. We paid it off, $2,040 to whatever bank it was in this example, Alpine Bank, if you will. So when the note extends over 2 periods, here we go again. Here we go. You got to make an adjustment, right? You got to, if it's December 31st, and you got to make an adjustment, right? Did we have this in chapter 3 where it was rent? I remember rent, because whoever came to their landlord and said, gee, can you give me a break on rent this month? And then they had to make a payable. Well, the same thing will happen here, because they didn't want to pay their rent in December. Maybe they wanted to get kids or presents for their kids and couldn't really afford it. But nonetheless, this note is going to go from, let's say, November to January. And so what are we going to do? December 16th, 2,000 at 12%, 60 days, and adjusting entries needed on the 31st. So what do we got? We got to start counting days. 15, 16 and 15 is 31. So you can see down here, record accrued interest, right? Accrued interest that we haven't paid yet. So it's going to be a payable of $10, right? 2,000 times 0.12 times 15/360ths, right? And then to finish up on February 14th, Valentine's Day, we owe the whole thing. So we're going to debit a notes payable. Let's debit that liability to get rid of it. I said it right this time. Thank the Lord. And then we had an interest expense and an interest payable. The payable to get rid of that we created up top here. And then of course that the rest of that expense to make up the whole thing, which is $2,040 is going to be. So the note cost us $40, right? And you can start to think about that. You know, it's the same thing as your credit card, if you have one. The idea that if you don't pay it, they instantly extend credit to you till the next month. At what rate? At what rate? And it turns out the rates are very high. And so credit card companies love it. They love it when you don't pay because they're charging you like 21%. All right, now employees. This is going to be fun. I just want to see something very quickly and see if I can add my buttons to this so that I can go back and forth with you. Let's see, what will we have? It would be on view, ruler, grid lines, guides. No. Fit to the window, no. Switch window, no. Macros. No, I guess not. Slideshow, look at slideshow. Set up slideshow? Huh. Use times, no. Monitor, use presenter. Always use subtitles? No. I know someone's at home looking at me bumble around going, dude, just do it this way. Buttons. I don't see them. All right, I'm going to have to do without them. Current slide. So employee payroll liabilities are from salaries and wages. Payroll liabilities are from salaries and wages. Employee benefits and payroll taxes levied on the employer. I don't know if you ever knew this before taking this class, but your employer pays payroll taxes, not just you. So in my way of thinking and logically, I believe, he doesn't actually, or he or she doesn't actually pay those. He just lowers your salary. So the federal government, the politicians trying to tell you, well, your employer pays payroll taxes. Well, yeah, she or he does, but it's crap. It's bullshit because you end up paying in the long run because you don't get your wages aren't as high. So it's just another way that they pull the wool over your eyes on these things. So we have the employee side, right? This is what the employer pays. Gross pay, net pay, right? What goes into net pay? Well, you deduct federal income tax, state and local voluntary deductions, FICA, FICA Medicare, and FICA Social Security. So, Federal Insurance Contributions Act. Watch how I pay attention to politics. For one reason, I can't stand both sides, so don't I'm not playing favorites here. This is a Roosevelt and the New Deal. We need, cradle to grave, take care of everybody type of legislation because of the Great Depression back in the 30s. So they call this FICA taxes, Federal Insurance Contributions Act. Social Security is anything but insurance, and Medicare is anything but insurance. They're not insurance. So to call them that is absurd. It's a lie. So their taxes and their funds, their wealth transfer funds to help out people who couldn't afford health insurance. It's charity. And for people who are retired that didn't save for retirement, they get a Social Security check. So, and you could say it's an entitlement. That's what they call them, and you could disagree with me. That's fine. I don't. I still like you, but the idea that these are insurance contributions is to me just a crock, and it's part and parcel to how government operates, which is by using lies. So FICA taxes, Social Security, 6.2 of the first 137,700 earned in a year. Why? Why in 2020, 6.2? Why doesn't it go up to a bajillion, gazillion? Well, because rich people tend to give more to political, what do we call it? They give to politicians more. So they capped it at 137.7 because you don't want to get the rich people mad. So you can tell that my opinion is that it shouldn't ever be capped. It should go no matter what you make. If you're going to have this stupid system that doesn't work, you should have it go right straight up. Why the cap? Same thing, and maybe underneath a certain amount you shouldn't have to pay, maybe. But anyway, FICA taxes and Medicare, same thing, 1.45 of all wages earned in the year. So as you can see, employee FICA taxes, that's employers must pay withheld taxes to the IRS, right? So it's 7.65% of your check is immediately paid to Social Security, Medicare. This is the employer's side, but you see the reduction in wages in your paycheck. So you're really paying it. That's the logical thing to say. Employee income tax amounts withheld depend on the employee's earnings, tax rates, number of withholding allowances. The employers must pay the taxes withheld from the employee's gross pay to the appropriate government agency. Again, in our country, there's no tax collector. They make your employer be the tax collector. So what that does is because your employer is a tax collector, that means he or she has to employ more people, right? In order to do these, do the bidding of the U.S. government. So they're like IRS agents that are embedded in every company. It's ingenious, but who pays for all that? Well, to drag on the company's profits to have extra people in order to adjudicate this employee income tax thing. So and all the other crap that they have to do, like garnishing people's pay and all that kind of stuff. So that also returns less profit to the employees, and they make less, and so it's another drag on the economy. So voluntary deductions, these depend on employees' request. Could be charitable giving, medical and life insurance premiums, right? If you have a medical program in your company, I had most recently with Sodexo, and now I'm paying my own way. But nonetheless, it was great having that system, but it's part of your pay. You get paid and then they take it out. It's not the magical health insurance fairy didn't give you money. You worked for it. So that's. I hope people understand that your insurance premiums are sucked out of your check. Pension contributions is a retirement program, a private retirement program rather than the public Social Security program. Union dues, if you happen to belong to a union, usually someone will say, "Are you pro-union?" At this point, and if I was in class and I say, "No, of course I'm pro-union. I'm pro collective action. That's the right level of collective action. What I'm against is government uh, giving favors to unions in order to buy votes. So I'm against the UAW for one reason: they're a corrupt operation, and they curry political favors and they pay off politicians in order to get votes. So employers owe voluntary amounts withheld from the employee's gross pay to the designated agency. And look at, here we are. Here's all of it together. An entry to record payroll expenses and deductions for an employee might look like this, right? And this is on the employer side, remember. So salaries expense is $2,000, but the payable is only $1,524, as you see where my cursor is, because all these things are being deducted. Okay, so that's about 25% of that check is deducted immediately. And that's before you actually pay your side of the payroll tax, or your taxes, the taxes you pay at the end of the year. So, oh yeah, would they come out here 213, but you may not pay you may get a refund or not pay all of that. So it could be different. However, you're paying one way or the other. All right, now recording and compute and record employer payroll expenses. Here's the employer side. I'm sorry, that was the employee side. Now we're on the employer side. Federal unemployment tax, FUTA, SUTA. These are the other things that they pay. In addition to, let's go back over here. In addition to recording this is on the employer side of recording an employee payroll, right? So you can see here, oops, right? Payroll expenses and liability at the end of each pay period. But here we're on employers, right? So employers must pay payroll taxes in addition to those required by employees. So this is what you're paying as an employee. This is what your boss is paying, employee payroll taxes, and they pay them equal to that withheld from the employee's gross pay. So a 0.9 additional Medicare tax is imposed on the high income employer to pay, usually in excess of 200 grand. This is not imposed on the employers, right? So the employees have to pay that extra. Finally, they're starting to figure out that we've got to make some of these wealthier taxpayers pay more, and that's one of the ways to do it. FUTA and SUTA, this is the one that's going to trip up our students. 6% on the first 7,000 to each employee. A credit up to 5.4 is given for SUTA paid. Therefore, the net rate is 0.6. And then it's 5.4 on the first 7,000 paid to each employee for the state. Because it's one of those federal programs where the federal government mandates the program and then allows the state to administer it, which you can, I don't know, it's a freak show. Recording employer payroll taxes, here they are. Again, There's Fuda and Suda, 124 and 29, right? Now look at, you can see the difference between the employee, right? Here's the employee, because there's union dues and what else? Federal income, medical insurance payable, that 85 and 25. That's employee. Here's employer down here, right? They have the additional of unemployment insurance. What does that do? Well, if you get laid off, you get paid. So, and there's the explanation down here if you're curious about that. So now we're going to talk a little bit about internal control. Very important. I don't know. I just get emails almost every day about the punching in a timekeeping machine over at Sodexo. You know, they don't want people kind of what do I want to say, gigging the machine. You know, messing around so you get extra time. And people don't mean it. I don't look for that. But sometimes I used it as a tool. I would tell certain employees, I said, listen, take an extra hour, and they'd be on to me. You know, I'd want to pay this person more, and they wouldn't allow me to pay them more. So I would gig it so they'd get some overtime and actually take home more money. But you got to watch that, because you don't want people paying all these taxes. It's not worth it. You know, so separation and monitoring as usual with internal controls. We went over some of these before. How do we hire, right? Who do we hire? Right? Keep fake workers off the payroll. That's one of the great fraud scams. You know, you create a fake worker and pay them and keep the money. You know, cash your checks. Payroll preparation, verify tax rates and payroll amounts. That keeps the rates updated, the amounts current, accurate. Timekeeping, I think I just said, you know, you want to keep people coming in and out 5 minutes before, 5 minutes after. You can set the machine. Payroll payment, sign and dock and issue pre-numbered checks. You know, checks valid, secured, and secured and correct. You know, are they right? So now we get to multi-period known liabilities, unearned revenues and notes payable. So that was payroll, fast, you know, like lickety split. Let's go. Multi-year known liabilities are here, include unearned revenues and notes payable. Here they are. What are unearned revenues? Well, we got paid, and down here you can see they use the Sports Illustrated example, which is a great example. That's that one I tried to use. Am I in the way here? Oops, I didn't mean to do that. I want to do that and move me. But yeah, you get that current portion of a long-term debt or current portion of 3-year digital magazine subscription, right? Notes payable extend over more than one accounting period. A 3-year note would be classified as a current liability for 1 year and a long-term liability for 2 years. Hopefully you can see how that might work, right? Estimated liabilities, including warranties or bonuses. This is going to be some of your homework again. An estimated liability is a known obligation of an uncertain amount that can be reasonably estimated. Pensions, healthcare, vacation pay, right? Reasonably estimated. Some people don't take their vacation. We were talking about this the other day. Who amongst my friends? I can't remember who they worked for, but you don't. We were talking at lunch. Some guys are working at, these were all men at the table. Some guys that work for use it or lose it companies. you know, oh, I was sitting with a policeman and another guy, and I won't say what town, but he's an awful good friend. And anyway, he he's in a use it or lose it situation. And I was saying, oh, when I was with the Roaring Fork Club, it was terrific because if you didn't use your vacation, it accrued. It kept piling up, and that was great because when they finally got rid of me, they had to pay me. They had to write me a check for all that sick time, which was kind of cool, if that makes sense. Pensions, healthcare, vacation pay. You try and estimate who's going to use their vacation every year so you can estimate payroll and things like that. Health and pension benefits. Assume an employer agrees to pay an amount for medical insurance equal to $8,000 and contribute an additional 10% of the employee's $120,000 gross salary to retirement, right? So in this case, here's their explanation, and you can see by this, right? The benefits expense that we increase with a debit has two payables that we credit, right? $8,000 for the medical insurance payable and $12,000 for the employee retirement program payable. These are these benefits. All right. Vacation benefits, right? And it's a payable. Assume an employee earns 2 weeks of paid vacation each year. Well, here it is. Vacation benefits expense is increased with a debit. Vacation benefits payable is increased with a credit, right? Credit. So that when the employee takes vacation, this is what happens. The payable is reduced. This $3,200 payable is reduced. Oh shoot, I did that again. Is reduced with a. It's reduced with a debit, $400. That's a week, I assume. Maybe it's 2 weeks. And then cash, of course, is credited to reduce the cash because you paid that vacation benefit, right? So it looks like a paycheck, but it's not really. It's a vacation benefit. So, oops, there we have it. I'll remove me there. And go back one. Here's a bonus plan. Same idea, sort of. Many companies offer bonuses to employees, and many of the bonuses depend on net income. Let's see how that works. To illustrate, assume the employer offers a bonus to employees based on the company's annual net income. At the end of the year, adjusting entry to record a $10,000 bonus is shown. And that's for everyone, right? Employee bonus expense and a bonus payable. It doesn't say who's getting it. It just says it exists, and you made this payable. I don't know, maybe it's cash and you just hand it out. Hard to say. Now, warranties are always interesting. And when you get to your capstone course here at CMC, you'll be running a company in a simulation, in a computer simulation. So it's fascinating. You can reduce the amount of things that come back on warranty by training people. And that's one of the many, many choices that you get to make while you're running this fictitious business. Excuse me. It'll give you the option of training your personnel, and that costs money. Well, if you train people, will you get less warranties? Yeah. And well, how much less? How much more? That's the question. Here's the definition of a warranty liability. It's the seller's obligation to replace or fix a product or service that fails to perform as expected within a specified period, right? Seller reports expected warranty expense in the period when the revenue from the sale is reported. Right, matching principle, periodicity. We're staying we're matching revenues with expenses in the period they occur. Thank you, Pacioli. And thirdly, the seller reports warranty as a liability. We can get an idea how many cars are going to come back. How many, when they say, oh, there's a huge recall at Ford, well, was it within their estimated warranty liability, or whatever they call it, recall liability. On December 1st, a dealer sells a car for $16,000 with a maximum 1 year, 12,000 mile warranty covering parts. Past experience indicates warranty expenses average 4% of a car's selling price. Well, 4% of 16,000, 16 times 4 is 64, right? So $640 would be debit warranty expense. And then we have estimated warranty liability of $640. That's a credit. We credit that liability to increase it. That's as of December 1st. Now, on January 9th, the customer returns the car for repairs. The dealer replaces parts costing $200. Oh, so the estimated warranty liability up here gets reduced with a debit, right? Estimated, it gets reduced with a debit, and the auto parts inventory gets reduced with a credit. All right, finally, and I think we're close to the end. Explain how to account for contingent liabilities. Well, what the hell are they? And this is just a decision graphic. How do we figure out if it's a contingent liability? Well, is the future event probable? Is it possible? Is it remote? I think last year I used the idea of a oil spill. If you were, driving boats around the Mediterranean filled with crude oil, how many of them are gonna run aground? Well, it's a pretty remote. It doesn't happen very often, so no disclosures needed. Is it possible? Yeah, maybe it's possible. I don't know. Is it estimable? Meaning, can I estimate it, or is it non-estimable? I don't know how to estimate it. Well, if it's probable that if I operate for long enough, something bad's going to happen, I can estimate it. It's like, here's an example. We make slingshots. Acme Slingshot Company. Is there going to be a liability? Well, we're going to get sued. Yeah, we're going to get sued. I think that the judges should throw it out. I don't believe in the 1964 Reformation of Torts by the ALI. I think it's a bunch of bullshit. Strict product liability is crap. People make things and you buy them. So when you buy them and you hurt yourself with them, it's on you. That's how I think. You don't have to think that way. That's how I think. But if you buy a slingshot and you hurt someone with it or yourself, I don't think you should be able to sue me. But that's not what happens. So you're able to sue me. And this is interesting in the gun discussion. You buy a gun and somebody gets hurt, it's on you. So contingent liability is probable. Can we estimate it? How many lawsuits are we going to have? If we make slingshots, how many a year? Lawsuits? 100, 5,000? I don't know. But we can estimate it and record a liability. If we can't estimate it, we disclose it in the notes, with the notes in the 10K, right? Remember 10K? That's an annual report. So you disclose in the notes something along the lines of, by the way, we make explosives, or we make slingshots. Somebody's going to get hurt. We can't estimate how many or whether or not they're going to win their litigation, so we can't really estimate what our liability is going to be. But we need to disclose this in a note so you the investor understand the risk. So that's a contingent liability, and here they are, potential legal claims that I just went over. Debt guarantees. Guarantor usually discloses the guarantee in its financial statement notes. Right? Did you loan money to your employees or something like that? Other contingencies, like I said about double hulled boats and running aground with oil, or if you run a railroad, you're going to tip over one of these cars every once in a while. Yeah. Environmental damages for sure. Possible tax assessments. They change IRS rules and suddenly you're taxed. Insurance losses, something burns, government investigations, things like that, regulatory BS. Everybody's susceptible to these other contingencies. You list those. Uncertainties are not contingencies. And this is where things get quite nuanced. Uncertainties from future events are not contingent liabilities because they are future events. They do not arise from past transactions. These are not disclosed. I think this is a great discussion to have about the climate getting warmer. Is it because we're emitting CO2? I tend to think that that's not going to be the driver. I don't think it's correct, but I don't know. It's an uncertainty. I have no idea. Do I have to disclose that? Now, most companies are being forced into the idea that it is certain. The science is settled and all that BS. Science is never settled, by the way. So we don't know if burning coal in our power plant is actually making the temperature rise. We're surmising that through study and modeling and things like that, but it's not. No one's been able to show me any proof of that. But nonetheless, it's what we would call the argument between a certainty and an uncertainty. Not contingent liabilities are the uncertainties, because they have future events. No one can predict the future, and especially the temperature of the planet. No one has a crystal ball on that. I would, if you think that mathematical modeling, can do that, you are simply wrong. That's not something we'll argue about. Your model is wrong. It's got too many variables to be an effective look at 100 years into the future. So, but we still use them, and we can make guesses based on what these models do and things. But so these are uncertainties that are not contingencies. Future events, because they're future events, they rise from past, do not arise from past transactions. These are not disclosed. Hurricanes, all sorts of things. Now, finally, we've got some tools. We got a few tools. We're almost an hour in. That's a good lecture to put up. Compute the times interest to earned ratio and use it to analyze liabilities. Why times earned? If income before interest and taxes varies greatly from year to year, fixed interest charges can increase the risk that an owner will not earn a positive return and will be unable to pay interest charges. So times interest earns gives you an idea of whether you're over leveraged. You've got too much debt. Income before interest expense and income taxes divided by interest expense, and that is how you come up with that. Now, here's an illustration, right? Diego Company, I guess this is 2.5 times interest earned. Is that good? Is it bad? Let's look at the videotape. Consider Diego's results and 2 possible outcomes. Expenses, including interest, are expected to remain at 75% of sales. Expenses that change with sales volume are variable. Interest expense is fixed at 60 a year. The sales increase column on 9.6 shows that Diego's net income increases by 83% to 165 if sales increase by 50% to 900. If the sales decrease column shows that net income decreased by 83% if sales decline by 50%. These results show that the amount of fixed interest expense affects the company's risk of its ability to pay interest. One measure of ability to pay is times interest earned. 2021, Diego's times interest earned is 150 divided by 60 or 2.5. They have low to moderate risk because its sales must decline sharply before it's unable to pay. If times interest rate falls below 1.5, a company will likely be at risk of not being able to pay its liabilities. So the lower, the more risky. The lower the number, the more risky the company is. Okay. Payroll reports and records and procedures. This is very good. They added these after a few years because a lot of you may be involved in doing payroll, and so it's great to understand these and know what they are. It's also going to be a question on your CPA. And everything, as you know, in the accounting world, if this is your first and last accounting course, you might not care what about IRS forms. But those of you who are sort of on are getting funneled into a CPA test eventually, you start to learn these things. So 941, 940, and W-2, payroll registered, payroll check, employee earnings. And then we have withholding tables and, of course, W-4. Corporate income taxes, again, this is a pass-through tax. There's a lot of economists out there who try to make this into something other than a lot of economists that are swayed by politics or have some other type of conflict of interest. But anyone who looks at this logically knows that corporations aren't people, and they don't pay taxes. People pay taxes. So corporations must pay taxes on income. Here's the liabilities. If you think, well, we're going to tax Apple enough to change the deficit, you're not. They're just going to pass the tax to you and increase the cost of the iPhones. So income tax expense, payable, right? There's the expense, debit, and the payable is a credit, accrue January income taxes, and then on April 10th, they're paying them. There's the actuals. So you see the actuals and the adjusting entry for the liabilities. They're just trying to figure out what they were. 21% currently due, 4,000 deferred, that kind of thing. So they're trying to figure out what their taxes are going to be, what they really are. And, it depends every year. Every year is a new year when now we're going to have another election in November. What's the first thing on the agenda? I don't know. We'll see. But taxes will be on the agenda, I assume, when if we are in recession. So, okay, that's what I've got for Chapter 9. I can't wait to see you all in class. Please come to class these last 4 weeks. I promise you'll pick up more and work together and get a better handle on this. And I understand that gas is $5 and all these other things, but it's your education, and I can't urge you enough. If you're just passively sitting and looking at the tape and you don't get the chance to comment on anything that I've said and push back at I'm a professor. I'm up here doing the same thing. I'm figuring it out. So If you can't have interactions in class, that's not, you're going to learn this trade. You'll be fine. Some of you, especially if you have high IQ, are going to do very well in this class. I can already see who you are, and don't mind sitting alone doing these problems. But if you're not wired that way, uh, come on to class and we'll do some problems together, and I promise you get more out of it. So that's my pitch, to get people to come to class. Have a great 4th of July. Remember, it's about secession. We seceded from a monarchy that was um, making us suffer through tyranny, right? Taxation without representation and things like that. There was a tyranny taking place. So the United States left England and we started our own country way back when, with the Declaration of Independence. If you don't read the Declaration, I urge you to do so. You can find it online. It's pretty simple to find. Declaration of Independence. See, look at here. They got it all over the place. So you can find it. And here's from the National Archives, right? Let's go there. In Congress, right? Dissolved. When a course of human events becomes necessary, people dissolve the political bands which connected them with another, and to assume among the powers of the earth a separate and equal station with the laws of nature, the laws of God, nature's God entitled them. We're talking about the natural law, not positivism, the natural law. Our rights were not given to us by government. They come from a higher power, if you will, or if you don't believe in God, then they come from, as they say here, separating laws of nature. That's what covers the secular world. We hold these truths to be evident that all men are created equal, right? They're endowed by the Creator with certain unalienable rights. That's right. So it's a very important document. So if you get a minute, read it, see what it means to you. Okay, enjoy the fireworks. I will see you next Monday. Please give me a shout, and I'll put up I'll put up another YouTube with chapter 8, and I think I'll have to look at what I've put up so that I'm not redundant. But let me know what questions you're having trouble with, and let's communicate as much as possible. Thanks so much, and see you next week.